in this video, I'm going to be answering a very common client question, which is, should I hold on to or sell stocks when they're falling in value and I've lost money in them? And I'm not only going to be answering this about stocks, but I'm going to be answering it about ETFs. And the answers are actually quite different. So when it comes to stocks, what we know is that over 100 years, and there's been some great studies into this, most stocks actually lose value. And I know it shocks a lot of people because they think that since the share market earns something like 9 or 10 or 11% per annum, it means a lot of stocks go up in value. But actually the recent study that's been done on this shows that of 29,000 or so different stocks that were studied, 51% of them fell in value over time. And a big part of that 51% actually went to zero. And so what we know about the share market is there's lots of companies that do very poorly. And so if you are an investor that just owns a handful of stocks, unfortunately, the risk is that you're caught in a lot of these stocks that go down in value. And that's why often people that are promoting investment strategies or talking about ways to manage risk in a portfolio, focus on this term around a stop loss, which is a way of mitigating your risk when you own individual stocks by setting a level at which, if that stock falls below it, you sell that stock. Now, as a risk mitigation strategy and a way of managing a portfolio, this may make some sense based on the data and given how many stocks actually perform poorly over the long run. However, it's really a market timing and stock selection strategy, and not one that we focus on at StockSpot, because the data more generally shows that it is very difficult to pick the right stocks over the long run and get in and out at the right time. And that same study that I just mentioned that looked at 29,000 stocks also shows that fact, because of the whole population of stocks that have ever been listed in the US, 17 stocks, just 17, have delivered returns of 5 million% and really driven most of the share market return. So if you're an investor in the share market and you didn't own those stocks, you really had a pretty poor time investing and didn't get anywhere near the same return as investors that own those stocks, which goes to, first of all, the benefit of owning an ETF because you own those stocks, but also shows why it's so important, if you're investing into direct shares, to risk manage your portfolio and cut losers. And it's why stop losses are quite common when it comes to investing in stocks. Now, you may think, and we get a lot of clients that ask us, is it the same with ETFs? When an ETF falls in value, should I be cutting my loss and getting rid of it in my portfolio and picking a new ETF? And my answer is going to be focused on index ETFs, because there are a few funky ETFs out there like leveraged ETFs and more niche ETFs where they can fall and fall 80 or 90% over time. But when it comes to index ETFs, my answer to that question is actually no. Because within a broader portfolio of different index ETFs, what you want to see over time is some ETFs doing well and some ETFs doing poorly, and they actually help to diversify each other. What we do when that happens is do a small amount of rebalancing, where we're selling the ETFs that have done well and buying some of the ETFs that have done poorly. So it's actually the opposite. We're usually recycling money out of the ones that have done well and putting it into the ones that have done poorly. But the basis for this is that an ETF owns a whole bunch of different shares, and within the ETF, they're constantly adding ones that are doing well and adding to ones that are doing well and removing ones that are doing badly. And so you're always getting rid of bad stocks in an ETF portfolio anyway, and therefore there's no need to really set a stop loss when managing an ETF within your overall portfolio, because that already happens within the ETF. And actually, if you've picked some great broad asset classes, and within our portfolios we have Australian shares, global, emerging market shares, government bonds and gold. These are all very big, broad, diversified asset classes, and there's really no need over the long run as an investor to be cutting losses or setting stop losses with these assets. You want to have them all in your portfolio, and actually, as one does well, you actually want to sell some of that and put it into the assets that have done less well to keep your risk overall in your portfolio rather balanced. And so my answer to that question is different for shares versus ETFs. For direct shares, because so many go down and so many go to zero, stop losses and risk managements are pretty important for an investor. Whereas when it comes to diversified ETFs, that risk management already happens within the ETF, and so you don't really need to sell them when they're down or set stop losses. You can just buy and hold for the long run. And that's one of the key reasons why we absolutely love ETFs at StockSpot. They're a fantastic hands-off way of growing your wealth and not needing to worry when things are going up and down.